Welcome to TaxLawGH and welcome to our video on tax planning. In this video, we'll take you through the essential elements of what goes into planning a business's tax affairs such that that business pays the least amount of taxes possible. In this video, we are not promising to make you experts at tax planning, but you'll be given all the essential ingredients you need to at least be aware of. You'll know where to look, you know the things to consider when it comes to planning a business's taxes. So let's look first at the tax planning key principles and concepts before we move on to the details. First thing we need to consider, what is tax planning? When we say tax planning, what are we referring to? At a very basic level, it is the analysis of a financial situation or financial plan to ensure that all elements work together to allow you to pay the lowest taxes possible. Take note here, the element or the focus is not on you dodging taxes or you using illegal means, but within the space given you by the law, within the legal room you've been given to operate. What measures, what plans, what activities, what steps can you take to ensure that the tax amount you are paying is the exact amount or the barest minimum, what you are actually supposed to pay at the lowest level, so that you don't pay more than you are required to pay. In addition to this, we are saying a plan that minimizes how much you pay in taxes is called a tax efficient plan. So at the very basic level, just know that a tax plan, or when you talk about the process of tax planning, it's a number of steps that you go through to analyze a project, a business, an idea, an assignment, a new stream of income, whatever it is that you want to do, a project as a business. The process you go through to ensure that at the end of the project, or by the time the project is carried out, or as you are even executing the project and undertaking that activity, you ensure that at every stage of the process, the amount of income tax you pay is the lowest amount possible you are legally required to pay. And take note, this video is covering income tax planning. Obviously, there are other ways we can do tax planning for indirect taxes. So we can have VAT tax planning, we can have excise duty tax planning, we can have customs duty tax planning, we can have tax planning for literally every tax. So just note that here we are focusing on income tax planning, which really is the focus of examination syllabuses. In a separate video, which will look at the advanced tax planning concepts, we'll look at how to plan the other more complicated and indirect taxes as well. Now that we know what tax planning is, what are the variables that go into tax planning? What are the elements that we consider when we are executing or drawing up a tax plan? What do you consider when you are undergoing the tax planning process? Just know that we have four essential variables, four essential elements, four key makeup elements that go into tax planning. The first is what we call the entity variable. Then we have the time period variable. Then we have the jurisdiction, or what some people call the location variable. We have the character, or what some people call the activity variable. So take note, entity, time period, jurisdiction or location, and character or activity. We will discuss each of these into a lot of detail such that you understand it so well when someone wakes you up in the middle of the night, you can rattle what each one of these will mean in details. Before we go on to actually discuss what entity variable means, time period variable means, location, activity means, let's look at one concept that is out there that is actually, to me, it's a settled debate, but people are still arguing what each of them means. The concept of tax avoidance and tax evasion. If you are watching this for the purpose of exam, just know this is actually one thing that comes once every 2 years. It's almost always there. So just know the difference between tax avoidance and tax evasion. Before I even go into the details, just know that one is very legal and one is very illegal. So one is correct, one is right, one is fair to use. And the other one, if you try it in your court, you could actually be sanctioned severely. Tax avoidance, let's look at that. When we say tax avoidance, at the very fundamental level, it consists of legitimate means of reducing taxes. So what legitimate means is going through what the law provides. What provisions are in your tax code if you are not in Ghana, wherever you're watching. If you're in Ghana, what provisions are provided in our income tax laws? In our case, it would be Act 896 and its corresponding regulations LI 2244. What provisions of law do we have there that you can take advantage of to ensure that you pay the least amount of taxes legally possible? That will be a very basic definition of tax avoidance. How does our Income Tax Act attempt to define tax avoidance? When you go to section 34, subsection 2 of our Income Tax Act, it says tax avoidance includes an arrangement, the main purpose of which is to avoid or reduce tax liability. So it also goes to show that the fundamental principle here is that for tax avoidance, you are trying to use legal means. You are not trying to break any law. You are trying to use legal means to pay the least amount of taxes possible. Then how does the Internal Revenue Service of the United States of America define tax avoidance? They say it's an action taken to lessen tax liability and maximize your after-tax income. So it all goes to summarize the point that tax avoidance is using legal means, very perfectly legal means, to reduce the amount of taxes you end up paying. Before I continue, just know that when it comes to tax avoidance, you can over tax avoid. What am I trying to say here? It is possible to over tax plan or to tax plan to an extreme such that your avoidance can begin to look like evasion. So take note, avoidance is legal, but if you over avoid, it begins to look like evasion. And as we'll find out very soon, there are many measures within the law that the Commissioner General can take to stop you from over avoiding. So remember, tax avoidance is legal, but if you over plan, if you over avoid, you try to find every single loophole in the law to take advantage of, then you may be shifting towards the realm of tax evasion. Remember this. Now that we know what avoidance is, what is tax evasion? This is the one I said is illegal. What is it? It consists of illegal means of reducing your taxes, and it is an offense punishable by severe monetary fines and imprisonment in some cases. In our context in Ghana, you end up paying interest, you end up paying penalty, and in some cases, you could end up in prison upon summary conviction in some instances. So just know that when you try to evade a tax, or when you try to do anything that will lead to evasion of tax, you could be severely punished. So evasion is illegal. Remember this. And how does the USA IRS define tax evasion? They say it's the failure to pay or a deliberate underpayment of taxes. So for tax evasion, you have made up your mind not to pay, or you've made up your mind to deliberately dodge. So when we come to Ghana, an example is you are required to register for VAT when you have made taxable supplies exceeding 200,000 Ghana cedis over a 12-month period. This is provided by Act 870, our VAT Act. If you've watched our VAT videos, you probably know this already. Let's say you have met the registration threshold and you are like, you know what, I don't want to register for VAT. This is clearly evasion. It's not avoidance. You have met a certain threshold that requires you to do a certain thing and begin to account for a certain tax. But because you don't want to incur any extra liability for our returns on a monthly basis, you don't do that thing. That is evasion. That is why the law imposes a penalty for failure to register. So remember, evasion is illegal, avoidance is perfectly legal. But in the middle, don't over avoid, because that could shift you towards the realm of evasion. Now that we know the difference between avoidance and evasion, let's look at the tax planning variables again, this time into a lot more detail. Remember when we started, I said we have 4 main variables. Recap, we have the entity variable, we have the time period variable, we have the jurisdiction or location variable, then we have the character or the activity variable. Which one is the entity variable? Here at the very basic level, before we delve into details, question you need to ask yourself is which entity is undertaking that particular transaction? What is the type of entity? And as we'll find out very soon, different entity types are subject to different tax rates and different tax rules. So by choosing entity A over entity B, or by choosing business structure A over business structure B. There could be tax advantages here and there, and you need to decide properly to know which one will minimize your tax liability as much as possible. Don't forget that the overarching objective, the overriding aim of tax planning is to minimize your tax liability to the lowest extent legally possible. So, entity variable is which entity undertakes the transaction. How about time period variable? Here, the question we are trying to ask is, in which tax year does the transaction occur? Because don't forget that the year in which a transaction occurs will typically be the year in which the amount will be taken into account for the purposes of determining the tax on that income amount. So, it is essential to let the amount fall into the appropriate year to determine the appropriate tax. So, as we'll find out shortly, there are different provisions that you can use to either defer the tax to a future period, or you can use to actually shift things around legally when it comes to the time period variable. How about the jurisdiction or location variable? Here we are asking, in which taxing jurisdiction or location does a transaction occur? From the perspective of local Ghanaian income tax, what you need to know is that here we are talking about location within Ghana. So when it comes to a particular income item, is it earned in location A or location B? As you find out very shortly in this video series, you realize that it is possible to pay different amounts of income just because one business entity is located 10 kilometers from another. Same country, just 10 kilometers apart. But because they are in different locations and they fall into different jurisdictional boundaries, they end up suffering different rates of tax. So here, when you are planning, ask yourself, do you want to site your business in location A or location B or location C? Because which one you end up choosing may end up giving you a lower tax rate payable. How about the character or activity variable? Here we are asking, what is the tax character of the income from the transaction? The income item we are seeking to tax, what is it from? As you find out also, when it comes to the activity, different activities attract different income rates. Now that we know at least high level what each one talks about, let's go and look at the entity variable into a lot more detail. When we say the entity variable, what we are trying to look at here is that we are saying generally, taxable income is computed under the same rules across business entities. So if you've watched our videos on business and company income tax, you remember that we looked at a number of principles that govern business income. When we went to employment income, we looked at a number of principles that govern employment income. So you know that so far, different entities or different businesses have different rules that apply to them. For example, what amounts can they deduct? What amounts can they not deduct? What amounts can they include in assessing their income? What amounts must they exclude when it comes to assessing their income? However, we are saying that tax on business income depends on the difference in tax rate across entities. I'll show you in the next second or two that depending on the entity type, the tax rate will vary, and this will have an impact on your decision making as a tax planner in your case. Before we continue, how does the law define a person? Once again, this was discussed into details in our income tax basic principles video. I think it was part 1, the very first video we did. We defined a person. We said a person means an individual or an entity. No need to go into details here. I'm assuming you've watched that already. How does the law define an entity? The law says an entity means a company, a partnership, or a trust, but does not include an individual. Take note, our Income Tax Act is saying that an entity does not include an individual. Granted, agreed. But for the purposes of our discussion, let's broaden the scope a little bit and say, when we say entity variable, we are looking at the taxing unit. Who is going to be taxed? So allow me to introduce individuals just for the purposes of illustration or for illustrative purposes. But remember that technically what our Income Tax Act says is that an entity does not include an individual. It just covers companies, partnerships, and trusts. And we have a video that covers taxation of partnerships, taxation of trusts, taxation of companies. So you can just look at those if you want the details as well. Now that we know who a person is, we know who an entity is, we know the fact that an entity doesn't include an individual. How does the law tax an individual as an entity or as a taxing unit? Remember, I've said individuals are not entities, but just let's look at them. When it comes to individuals, if you are a resident individual, you are taxed differently from a non-resident individual. Once again, the concept of residence has been discussed at length in the income tax basic principles video, so no need to go over them. But just know that for individuals, it is possible to be resident and non-resident. And as you probably already know by now, you can actually be in Ghana physically, but still be non-resident for tax purposes. So just remember all of these things for now. We are saying that for resident individuals, we use this income tax rates to tax them. Some people prefer to call this the graduated schedule or graduated rate or graduated table. I choose to call it the personal income tax rate. Whichever way works, it's fine. For resident individuals, you can see it starts from a nil or 0% or free tax band. It goes through a number of tax bands and it ends at 30%, which we call the marginal income tax rate. It means if you earn 3,828, this is the rate as of today. If you are watching probably 2 years from now and the rate changes, I'll probably update this video. But for now, just know that as at the date of recording, this is the rate for resident individuals. So we are saying here that a resident individual is taxed according to a number of income levels. So as your income increases, then your tax rate will marginally also increase as well. So your first 3,000 cedis, 3,800 roughly, is tax-free. This is an annual income. Take note, all of these figures are annual. Then your next 1,002 will now earn 5% income tax or attract 5% income tax. Your next 1,440 will attract 10%. Your next 36,000 will attract 17.5%, all the way up to 30% when you are earning in excess of 240,000 for a year. As opposed to a non-resident individual who is taxed income tax wise at a flat rate of 25%. So when we look at even planning for individuals under the entity variable, what we are saying here is depending on your resident status, you could suffer different income tax rates. So let's say, practical example, if you have a non-resident individual who is earning 5,000 cedis, remember that because they are non-residents and non-residents attract a flat income tax rate, their 5,000 cedis will attract 25% flat. However, a resident person will end up paying less than 25% because don't forget that because this is cumulative, they'll probably end up in the looks like the little bit 5%, 10% band. So the resident individual will pay lower taxes as compared to the non-resident person. So take note, if you look at it, actually you end up being the 5% band, typically, yeah, on average. So a resident person earning 5,000 cedis roughly will pay a lower amount of rate, roughly 5%, 10%-ish, and then the non-resident will pay 25%. So you can see for a lower amount of income, a non-resident individual will pay more tax as compared to a resident individual. Let's flip the switch a little bit. Let's look at a resident individual who is earning 1 million cedis as compared to a non-resident earning 1 million cedis. You can see that the resident person will end up paying in excess of 30% using the rate here, whereas the non-resident will have a flat 25%, capped at 25%, no matter how much their income is. So you can see it works both ways, but just to emphasize that when it comes to the entity variable, it's possible that even at the individual level, different tax rates will apply. So residence is an important factor to consider. Still under the entity variable, even for companies, even for other entities, even for partnerships, even for trusts, remember that we are saying there are different rates. And before I even continue, let me show you this one more time. If you watched our video on partnership income, we said that for partnerships are not taxed as an entity per se, but the income of the partnership is taxed in the hands of the partners after the partnership income is shared or distributed to the partners in accordance with the partnership's profit and loss sharing ratio as detailed in the partnership agreement. If you haven't watched our partnership and trust video, you can just take a look at that. Back to this. Look at the rates for different entities. For planning purposes, what does it mean for you? We are saying generally, companies have a corporate income tax rate of 25%. Trusts also attract a company income tax rate or a trust income tax rate of 25%. However, if a company begins to be engaged in the hotel industry, then their rate drops from 25% to 22%. You can see they are both companies, but under the entity variable, one being a hotel is now paying a lower tax rate as compared to the other. If a company is engaged in the export of non-traditional goods, then their rate drops to 8%. All of them are companies, all of them are entities, but there's a differential in income tax rate. Some people may push that this can also fall under the activity variable, and they are not wrong, because here, what activity are they into? Hotel industry. What activity are they into? Export of non-traditional goods. Just understand that the principles are not so strict. Some of them overlap in some cases, but for discussion purposes, let's discuss these under the entity variable. How about financial institutions? We are saying their income derived from loans granted to farming enterprises will be taxed at a lower rate of 20%. Then their income derived from loans granted to leasing companies will be a lower rate of 20%. However, if you take another financial institution that does not grant loans to farming enterprises or that does not grant loans to leasing enterprises, that financial institution will end up paying tax at 25%. So pick a typical commercial bank that all they do is to loan to individuals, like say personal loans, car loans, and mortgages and all of that. Because they are not giving loans to farming enterprises or leasing enterprises, they will be taxed at a higher rate of 25%. So let's say you are an investor, you want to decide on which financial institution to invest in. You can choose to go for company A or company B based on what their loan portfolio looks like. If the first company loans primarily to leasing or farming enterprises, then you know that at the end of the day, your income will be subject to tax at 20%. Whereas if it's a normal everyday commercial bank who loans primarily to individuals and corporates, then you know they'll be taxed at a higher rate of 5 and 25%. That is a 5% corporate income tax gap. It's a lot of money if you think about it in terms of the amount of profit that could be involved. So this under the entity variable shows that even for financial institutions, same industry, but depending on who you are loaning to, you could end up paying different rates of income tax. Then there are entities we call free zones enterprises. We have videos on free zones which we'll upload shortly, should be on the channel by the time you're watching this. When we talk about free zone enterprises, these are special entities who are under special regimes where if they meet some thresholds, not to bother you here in terms of import and export and what they are allowed to supply to the local market and all of that, then for the first 10 years of their operation, they pay tax at 0%. So imagine that you are a company. If you changed what you were doing, which here I could say it also falls under the activity variable, but for now, let's look at standard entity variable. So for a free zone company or developer who has chosen to register with the Ghana Free Zones Board, they will pay 0% income tax for 10 years. The same entity, if they were not a free zones entity and they were doing something else, that same entity will pay corporate income tax at most likely 25%. So remember that a company could pay 0% as opposed to 25% just because of a certain registration with a certain body in Ghana, the Ghana Free Zones Board, and undertaking a specified type of activity, predominantly export. So remember that free zones developers attract or get a corporate income tax rate of 0% for the first 10 years. And 10 years is a long time. In the same vein, we are saying free zones enterprises, after their 10 years, if they export their outputs, then they pay corporate tax at 15%. So even after their first 10 years where they incur 0%, when they begin to export, they pay a lower rate of 15%. If they sell to the local or domestic market after the 10-year period, then they attract 25%. So same free zones company, if the investor decides to push the business to do export as opposed to local sales, you can see there's a differential of 10% because domestic sales will attract 25%, export sales will attract 15%. Are you willing to bear that extra 10% in corporate income taxes just because of a change in activity? So here's another thing to consider when it comes to planning. When it comes to mining companies and upstream petroleum operations, they attract a corporate income tax rate of 35%. Actually, this is the highest corporate income tax rate provided in our laws. So here too, an entity is also a company registered under our Companies Act of 2019, Act 992, just like every other company. But because of what they do as an entity, here they pay a higher corporate income tax rate. So these are the key things we need to remember when it comes to the entity variables. But now that we've looked at rates, what other key concepts must you consider under the entity variable? If you forget anything at all, remember this principle here, that tax costs decrease. And as a result of that, your cash flows will increase when income is generated by an entity subject to a low tax rate. And you agree with me? If your tax rate is lower, your tax cost will be lower. And if your tax cost will be lower, you should have higher cash flows, all things being equal, right? So your tax cost will decrease and your cash flows will increase consequently when your income is generated and that entity that generates the income is subject to a lower tax rate. Because of this, when establishing a new business, you need to consider the tax rates paid by the type of business entity. So are you going to establish a partnership? Will it be a limited liability company? All of these considerations about the entity type, will it be a free zones company? Will it be an entity into exploration of minerals, an entity into the upstream oil and gas sector? Will you even be in the midstream or downstream, because they will end up not getting 35 but lower rates, most likely 25%. So the entity type you choose, the entity registration you end up with, will it be a sole proprietor? Will it be a company limited by a guarantee? And if it's company limited by a guarantee, then you need to think about things like, if you're a charitable organization, do you have the Commissioner General's approval under Section 97? Right? So all of these different factors will come into play when it comes to deciding the entity and the tax that will end up being levied on that entity. Let's look at a concept called income shifting. What does income shifting mean? We are saying here that this is where you arrange transactions to transfer income from a high tax rate entity to a low tax rate entity. So let's say you are an investor or you are a business owner and you run two different companies. When it comes to income shifting, what you are trying to do here is to shift all the income from the entity that is going to pay a higher tax rate to the entity that's going to pay a lower tax rate, so that the lower tax rate entity is the one that will bear the tax. This is called income shifting. As the name implies, you are trying to shift income from a higher tax entity to a lower tax rate entity so that you pay lower taxes. It depends on how you do this, but if you overdo this, it is possible that you end up being caught for evasion. But the key principle to take away from here is that our law provides for ring fencing, really. So every tax entity's income will have to be determined separately from the other. So it's difficult to do income shifting under our income tax law. And now, as we'll find out shortly, the Commissioner General has the right to prevent some form of this happening. We also have another concept called deduction shifting. What happens here? Here we are saying you arrange transactions to transfer your deductions from a low tax rate entity to a high tax rate entity. And what does this mean? Remember that if you have deductions and those deductions are allowable deductions under the law, let's say they are not domestic or excluded expenditure and they are allowable, those allowable deductions will end up reducing your taxable income, all things being equal. So if you are actually having income sitting in a low tax rate entity, you also have income sitting in a high tax rate entity, what you want to do is to push all your deductions to the high tax rate entity, such that the high tax rate entity's income after deductions will be lower, so that the high tax rate will even be applied on a lower figure. So your job here is trying to shift all the deductions to where the tax rate is high, so that by the time you take out deductions, the taxable income will be lower and you end up paying lower taxes. Key thing to note here is that after an income or deduction shift, the parties in their aggregate are financially better off by the tax savings from the transaction. So when you're able to execute income shifting or deduction shifting from entity A to entity B, depending on which one has a lower or higher tax rate, we're saying that in the end you should be better off if you're able to successfully carry this out. So let's pause here in this video. In the next one, we'll continue with the entity variable and the other variables as well. So if you love this, don't forget to smash the like button and don't forget to share this video within your entire network. I'll catch you in the next video.